Welcome back to Investing Talk Podcast.
Today we're looking at Weibo.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For Weibo, the third quarter of 2025, it wasn't just a strong reporting period.
No, not at all.
It was, by all measures, a really major financial inflection point. It just fundamentally shifts the whole investment story.
It does. It goes from that high-growth, money-losing narrative to, well, something very different.
To a company that has proven its model actually works at scale.
And that shift is something we absolutely have to break down. I mean, the top-line numbers alone were huge.
Yeah, they were.
55% year-over-year revenue growth, landing at, what, $156.9 million?
Yeah.
But honestly, that's not even the real headline here.
Not even close. That's almost just window dressing.
Exactly. The real news is the swing to net income. We're talking $36.9 million in profit, coming from a pretty big loss this time last year.
And that's the pivot. When a business that's scaling that fast finally makes that turn.
It tells you their fixed costs are finally being covered by all that transactional revenue.
Precisely. That move from loss to profit is the whole story. It shows the market this isn't just growth for growth's sake. It's efficient growth.
So what drove it?
Heavy operational activity. Their trading-related revenue just surged. It was up 64% year over year. That's a huge sign that all their user acquisition is finally translating into, monetizable volume.
Okay, but I have to ask, how much of that is just a hot market? I mean, if volumes dry up tomorrow, does that $36.9 million in profit just disappear?
That is the right question to be asking, and I think the answer is in the asset accumulation. That's what shows a deeper user commitment.
Right, the stickiness.
Exactly. Customer assets expanded by a really remarkable 84% year over year.
84%, wow.
Yeah. That brought their total customer assets to $21.2 billion. This isn't just fleeting day trading activity. This points to sustained user confidence, significant net deposits.
All right, if I'm moving $10,000 onto a platform, I'm probably planning on staying for a while.
And those users are clearly active. We saw equity volume jump 71%, and even options contracts, which are, super high margin for brokerages.
I agree too.
Up 24%. Those high volumes tell us Weibo has really captured that segment of, let's call them sophisticated retail traders who are very, very engaged.
And this brings us back to what you said earlier about efficiency, the operational leverage.
The most critical number, I think. Growing revenue is great, but operating efficiently is better. They reported an adjusted operating profit of $36.8 million, a massive swing from a loss. Their adjusted operating margin expanded all the way to 28.7%.
Okay, let's pause on that margin expansion for a second, because that's the how. A 28.7% margin, while you're still investing like crazy in new markets and tech, that suggests some serious cost discipline. How are they doing that?
It's a tightrope walk for sure, but that margin tells you the infrastructure they built years ago, the core trading engine, the basic app, it's now handling way more volume without needing, 5 or 6 times the staff.
So the foundation is just that strong.
That efficiency is the engine driving the profitability we're seeing now.
Okay, so financials look solid now. Let's talk about the competitive edge.
Yeah.
How do they keep this up when so many other digital brokers offer basically the same thing? What's the real moat here?
Well, the first layer of that moat is just pure scale and, importantly, targeting the right user.
Okay.
They're getting close to 26 million global users with almost 5 million, 4.93 million to be exact funded accounts. That large active user base just generates a level of transaction revenue that smaller players can't even touch.
And you said the right user, so they're not going after just anyone.
No, they're targeting that high-frequency, mobile-first, highly engaged trader who actually wants those high-tech tools.
Which brings us to product innovation. If the basic platform is a commodity, then the advanced tools have to be the
differentiators, absolutely. And that's where they're positioning themselves, not just as a trading platform, but as a tech partner.
with things like the AI investments.
Exactly. They're rolling out AI-driven tools like the Vega AI system, which gives users personalized insights that moves them up the value chain. Plus, they've diversified into crypto again, and corporate bond trading.
So more revenue streams beyond just simple stock commissions.
Right. And I think the most powerful part of their moat, and the one that's most overlooked, is their global vision.
They aren't just trying to win in the U.S. market.
Which is completely saturated. No, they're executing a massive geographic expansion that they're U.S.-centric rivals just aren't focused on.
And that's not easy to do.
It's incredibly difficult, but their expansion into South Korea proves they can do it. They can localize the platform, handle compliance, and if you listen to the rumors, we could see them in Singapore, Hong Kong, or Japan very soon.
Which insulates them from risk in any one country.
That's a huge part of it. When you combine that profitability pivot with the global vision, it's no surprise investor sentiment has turned so positive. We're seeing strong insider buying.
Executives putting their own money in, that's always a good sign.
It's a classic signal of confidence, and, crucially, institutional inflows are on the rise.
The big money is moving in.
When hedge funds start accumulating stakes, it adds a layer of stability and really validation to this story. They're betting that this profitability is here to stay.
So speaking of the future, let's pivot to the forward view. What are the upcoming catalysts people should be watching over the next 3 to 6 months?
The near-term focus is, without a doubt, the Q4 earnings report. That's expected in February 2026.
The big one. Management's chance to prove Q3 wasn't a fluke.
Exactly. The market is going to be watching for sustained margins and continued volume growth. But even before that, you have seasonal tailwinds. December trading volume is usually higher.
Right. Year-end portfolio moves and holiday trading.
It usually means higher transaction revenue.
Okay, beyond the scheduled reports, what about the speculative catalysts? What's the market chatter?
There are a few big ones. One is about accelerated institutional adoption. If Webull can successfully use its tech to bring in corporate or fund clients with new custody partnerships.
That would totally expand their market beyond just retail.
Massively. We also hear constant whispers about the official launch of those proprietary AI-driven trading assistants, maybe tools that carry a premium subscription fee.
Boosting that average revenue per user.
Yeah.
And what about M&A? That's always a hot topic in fintech.
The rumors suggest it could be a key strategy. They might look to acquire smaller complementary fintechs to get new tech or to, fast-track their entry into a new region like Europe.
A confirmed acquisition would be a huge signal of their confidence. So with all this bullish news, how is the stock itself actually behaving?
The technical picture is very healthy. There's a confirmed bullish trend. The stock is trading clearly above both its 50-day and 200-day moving averages.
Which is a very strong signal of momentum.
It signals our real trend reversal after that profitability news. And indicators like the RSI and MACD, they're showing upside potential, but without being in that dangerous overbought territory. It suggests there's still room to run.
All right, we've covered the bull case pretty extensively, but we have to be balanced. What are the key risks that could just completely derail this whole story?
The biggest one, and this is for any zero-commission brokerage, is regulatory dependency, specifically around payment for order flow, or PFOF.
PFOF.
A big chunk of their revenue comes from that. For listeners who don't follow this, PFOF is basically the fee brokers get for sending your orders to specific market makers.
And that's at risk because
new regulations, either in the U.S. or internationally, are always on the table. They could restrict or change PFOF. If that revenue stream gets squeezed, it directly hits Webull's bottom line and could compress those margins they've worked so hard to build.
And that's a risk that's pretty much out of their control.
Almost entirely.
Yeah.
Then there's just plain old execution risk. We praise their operational leverage.
But scaling this fast is always risky.
Absolutely. Managing expense growth, especially with all the tech investment for AI and global expansion, it's going to be a challenge. If they overspend chasing those licenses in Asia and Europe, that profitability could vanish pretty quickly.
And the whole model depends on high volumes, right?
Yeah.
If the market just goes quiet.
Revenue slows down no matter how efficient they are.
Okay, finally, let's touch on the capital structure. They recently filed about a standby equity purchase agreement. It covers up to 147 million shares. That sounds like a lot.
It is a substantial number. Now, the positive spin is that this gives them a ton of flexibility to raise capital quickly if they need it for, say, an acquisition.
But the downside is
The overhang of potential dilution. The fact that they have the option to issue that many new shares means existing shareholders could see their ownership stake get watered down. It's also worth noting their book value per share is still negative.
meaning evaluation is based entirely on future growth, not current assets.
Which is a risk if sentiment ever turns against them.
So to sum all this up, where does that leave us? It feels like Webull has hit that critical inflection point, but the path forward really hinges on perfect execution.
Precisely. Q3 was the proof of concept. The investment thesis now depends on two things. Can they keep that margin discipline while expanding across multiple continents? And can they navigate the whole PFOF regulatory landscape?
So if they hit those global targets and keep innovating with products like Vega AI,
Then the bullish case has a very, very solid foundation.
it sounds like the key things for you to monitor are the execution of those international licensing announcements, especially in Asia, and the commercial reception to the Vega AI product line adoption. Those will be the elements that shape the stock's trajectory going forward.
My pleasure.
Don't forget to subscribe and like this video to keep up with all the latest market analysis from Investing Talk Podcast.